Hello, good morning. I am Avnish Jain. Welcome to this monthly fixed income outlook from Canara Robeco. Let's look at the global situation. Global news headlines are dominated by US-Iran conflict. We have seen US-Israel attack Iran on 28th of February, and the conflict continued well into March, and before an uneasy ceasefire was reached on April 8th. President Trump did not get what he wanted from the Iranian regime, and to that extent, now they have put a blockade into ships going in and out of the Strait of Hormuz. The Strait of Hormuz has been effectively blockaded by Iran on threat of attack on ships passing through the strait. However, few ships did go through, but that was not sufficient enough for the world economy. Almost 20% of world oil flows through the Strait of Hormuz. The US now wants to blockade Iran from exporting any oil to force it to come to negotiation table. Iran is still not giving up its nuclear ambitions, and that is what US wants. US wants Iran to give up on the nuclear weapon development program before they can release the stock blockade and let Iran sell oil in the global markets. Markets have been up and down throughout this month. After April 8th, on the ceasefire being announced, markets recovered, both equity, debt markets, and we did see a rally in US rates as well and US markets. Indian 10-year yield had climbed to 7.14% in April due to the continuing war in Middle East. However, post the ceasefire agreement reached between US and Iran, market recovered. We saw Indian market 10-year yields coming down to about 6.85% before US started blockading the Strait of Hormuz. This again led to rise in oil prices, which had dropped to a low of around $88 to $90 per barrel after the ceasefire, back to above $100. Currently, we are seeing Brent oil prices around 113 to 120 dollar per barrel due to the continued siege of the Strait of Hormuz by the US. In the last few days, we have seen US looking at various other options on restarting bombing in Iran. That has further led to a rise in oil prices. Yields also have risen in line with the increase in oil prices. In terms of other markets like equity and forex, we have seen similar volatility. In the US, 10-year US yield has fluctuated between 420 to 440 during all this action. The US Federal Reserve in the last meeting have kept the rates in a pause mode, of course because of the continued escalation in Iran, and there is no end in sight of the war. It is very difficult for anybody to take call on where markets will go and how the inflation will pan out in the coming months and weeks. In India also, RBI has been on pause in the last two policy meetings. In the last policy meeting, RBI did say that they will likely look through the supply shock, but it depends on how long the supply shock is going to be. In the next upcoming meeting, it is again expected that RBI will remain on pause, still looking at data flowing through on the inflation numbers and on growth numbers. Oil prices in India, especially diesel and petrol, have not been revised since the outbreak of the war, and they remain in a state of flux. While we have seen ATF prices rise very sharply, and other deregulated prices also, especially LPG, also have seen sharp rise. It was probably due to election code of conduct that the government did not increase prices. Prices may rise in the near future, and we have to see how much government wants to pass on to the consumer. Government had reduced excise duty both on petrol and diesel to cushion impact on the oil marketing companies in early part of April. However, the price rise is consistently on the higher side, and we may reach a level where government may be forced to pass on the price increases to the consumer. This may lead to little bit of higher inflation in the coming months. Further, the India Meteorological Department, or IMD, had forecast 92% rainfall, which is below average. This is because of forecast of a El Nino activity during May to July period. This falls squarely between our monsoon season, and this could impact rainfall in India, especially in the hinterland areas where anyway the rain dispersion is not very good. Government then probably has to resort to increasing supply through their holdings of various feedstocks. The rise in oil prices, coupled with the expected rise in food prices because of El Nino impact, may see inflation rise for the next few months. We have to wait and see how RBI reacts to this rise of inflation. If RBI feels that inflation is transitory and it is only in food prices, they may wait and watch before taking any action. However, if inflation seems to be passing through to secondary articles and into core inflation, RBI may be forced to act. Again, without any concrete data, one cannot say with certainty how RBI is going to look at various inflation scenarios. Growth also is expected to be impacted. Earlier expectation was 7.4% growth in FY27 before the war started. Now markets are predicting 6.5 to 7% growth rate considering the current situation. However, if the US-Iran conflict drags on for more months, it could adversely impact energy flow and energy demands across nations. It could also lead to destruction in demand due to higher oil prices, which will have impact on growth. We are already seeing higher airline prices pass through the tickets, and this could again put some pressure on inflation. Inflation in India has been on the lower side, though it has climbed up a bit. In March, inflation was 3.4%. In April, the number may not rise too much, but considering that there could be impact due to expected increase in oil prices as well as food prices, inflation may go up RBI's target of 4% in the next few months. Overall, RBI in the last policy meeting had projected a slightly higher inflation expectation of 4.6% for FY27. This was taking into account Brent oil price of $85 to $90. Right now, Brent is above $100. So it is possible that RBI may again tinker with their inflation projections. However, RBI's target range remains between 2 to 6%. RBI can take a step back and let the supply shock work its way through the system before taking any concrete action. In this scenario, things are very, very volatile. Interest rate movements have been moving up and down depending on situation in the Middle East. In terms of market, we believe that the rate cut cycle is probably over and the next step of RBI would be likely to increase rates. However, Governor in the last policy press meet had indicated that rates could remain lower for longer, indicating that RBI was in no hurry to raise rates and probably again, as discussed, would look through some supply shocks which could be transitory and then take action depending on the incoming data. In this scenario, investors may choose to invest in funds like liquid fund, savings fund, short duration fund, corporate bond fund, and banking and PSU debt funds. These category of fund typically invest in corporate bonds which generally trade at a good spread over government securities. As usual, investors should look at their risk profile and their investment horizon before investing in debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.